You're looking at companies reporting billions in profits. But what if I told you they never made that money? There's a legal accounting trick used by banks, funds, entire markets that lets them count imaginary gains as if they were real. And here's the twist. It's not illegal, it's standard. So the question is, how much of the market is real and how much is pure illusion?
Every system has a weak point. In the financial world, it's hidden in the footnotes. Tucked inside accounting rule books, buried beneath legal language, lies a loophole so quiet most investors don't even know it exists. It's called mark-to-market accounting, and it changed everything. After the Enron collapse in 2001, regulators wanted transparency. They thought if companies have to value their assets at current market prices, they won't be able to hide losses anymore. What they didn't predict was that companies would use this rule to hide something else entirely: reality. Here's how it works. Let's say you're a hedge fund. You invest in a complex derivative, one with no active market. There's no buyer yet, no cash flow, no guarantee of return. But under mark-to-market, you don't need to wait. You just estimate how much it might be worth and count it today as profit. You haven't sold it, you haven't received a cent, but your books show a gain. Because under this rule, as long as you can justify the value, you can pretend it's already in your pocket. Now multiply that by hundreds of positions, then by dozens of funds, then by entire banks. This is not exaggeration. This is how the system works. Welcome to a world where money is made before it's earned, where risk is invisible because it's dressed as growth, where future guesses are packaged as present value, and no one's questioning the math. And here's where things get uncomfortable. Even when those assets crash later, there's no immediate reckoning. Losses can be deferred, revalued, hidden behind jargon. Estimates get adjusted. Reports get revised. The illusion survives because the system needs it to. You're not just watching creative accounting. You're watching the financial industry build castles on forecasts. And the result? Balance sheets full of optimism, quarterly earnings that look invincible, portfolios that seem solid until they're not. It's easy to assume this only happens in obscure corners of finance, some offshore fund, a no-name investment firm. But this isn't niche, it's mainstream. BlackRock, Goldman Sachs, Morgan Stanley, they all use this rule, not because they want to, but because it's standard. And once you understand that, ask yourself, how much of the market is built on actual value, and how much is just vapor? Before we dive deeper, before we name the players who turned this accounting rule into a money machine, pause for a moment. If you're still watching, it's because you're not here for noise. You're here to understand how wealth really moves, who pulls the levers, and how the game is played behind the scenes. So do this now. Hit like, subscribe to Bull Secrets, and stay with us. Because the next layer of this story isn't a theory. It's documented manipulation, approved by regulators, executed by insiders. And once you see how it works, you won't be able to unsee it. We're about to meet the architects, the ones who turn this accounting logic into a tool for exponential gain, not by investing smarter, but by bending perception. And the higher they climbed, the more invisible the risk became. Until now. They weren't criminals. They were celebrated, praised on CNBC, quoted in the Wall Street Journal. Men in tailored suits, smiling as their funds posted record returns, returns that, on paper, looked miraculous.
But behind those numbers was a game of valuation theater. Meet the early adopters. In the early 2000s, a few hedge funds realized something disturbing. Under mark-to-market rules, reality became optional. If you controlled the model, you controlled the money. Take level 3 assets, the ones with no active market. Instead of using actual prices, firms used internal models, assumptions, comparable estimates. In other words, whatever math made the portfolio look profitable. And here's the twist. The more exotic the asset, the easier it was to justify any number. That's where structured credit came in. CDOs, synthetic CDOs, swaps built on swaps. A labyrinth of products so complex most regulators didn't even understand them. But the firms selling them, they weren't confused. They were in control. By 2006, firms like Bear Stearns and Lehman Brothers had loaded their books with these instruments. They reported massive gains, valued not by market price, but by belief. They called it financial engineering, but it was more like financial storytelling. And it worked. Investors flooded in, executive bonuses soared, a culture formed around modeling the truth, a phrase that should have raised alarms, but didn't. Because as long as the illusion held, no one wanted to ask questions. Now enter the investment banks. They weren't just using the trick. They were building products designed to benefit from it. Packages of mortgage-backed securities sold with optimistic assumptions baked into the models, each layer marked up, each piece generating profits before anyone paid a dime. And when market conditions shifted, when cracks began to show, they didn't unwind the risk, they adjusted the inputs. What happens when your valuation model is more important than your actual performance? You stop looking at reality and start managing perception. That's exactly what happened. At one point, a senior executive at a major bank reportedly said, "If the model says it's worth 100 million, then it's worth 100 million, unless you want to challenge the math." Think about that. Not earnings from real sales, not dividends from real assets, but theoretical value defended by internal math treated as truth. And this wasn't a fringe practice. By 2007, it was embedded in the system. Entire bonus structures were built on unrealized gains. Risk managers were overruled. Accountants were pressured, because the higher the mark, the bigger the reward. Even as cracks deepened in the housing market, Wall Street reported growth, because the numbers said so. But numbers, when unmoored from reality, can become weapons. And the ones holding them weren't just playing the game, they were designing it. The most chilling part, this system didn't collapse because of regulation. It collapsed because the illusion couldn't stretch any further. So ask yourself, if that happened once and the rule is still in place, what exactly are we sitting on now? Because next, we're going to expose how this exact logic, the weaponization of mark-to-market, didn't end with the crash. It evolved. And today, it's hiding inside the portfolios of the institutions managing your retirement, your savings, your pension, and no one is warning you.
After 2008, you'd think the lesson was clear. Over-leveraging fake profits, modeling risk out of existence, that nearly collapsed the global economy. But instead of dismantling the system, Wall Street refined it. New regulations came in, but none of them closed the original loophole. Mark-to-market survived. It was too embedded, too profitable. So the illusion didn't die, it matured. This time, it wasn't just toxic mortgage products. It was anything hard to price. Private equity, venture capital, private credit, shadow banking structures. If it wasn't trading daily, it could be valued creatively. And who leads this new wave? The biggest asset managers on the planet. Firms like BlackRock, Apollo, and Brookfield now manage trillions, and increasingly, their portfolios are packed with assets that don't have real-time prices. Infrastructure, startups, loans to private firms, illiquid by nature. But here's the kicker. They still mark them up, quarter by quarter, using internal models, just like in 2007. A single real estate project might get revalued upward because of future rental potential. A tech startup with no revenue might be worth billions on paper because it had strong user engagement. These gains are unrealized, untested, but they're treated as real returns. And those returns, they attract more capital from pensions, endowments, sovereign wealth funds, money that belongs to people like you, people who think their savings are safe because the statements show growth. But what happens when the estimates stop rising? What happens when the model can't be stretched any further? We're already seeing the edges crack. In 2022, as interest rates rose, the value of many private assets should have dropped. Less credit, less risk appetite, lower multiples. But many funds kept valuations flat or even up. One fund marked a private equity stake at 35% above its last public comp. Another kept a startup at unicorn status even after 2 funding rounds collapsed. They claimed their models reflected long-term value. But what if those models were just hope? And here's the bigger risk. When private markets get too big to fail and too opaque to audit, they become a time bomb. By 2025, private markets represent over $13 trillion globally. That's larger than the subprime mortgage market ever was. And yet, there's no mark-to-market watchdog, no regulator checking the math, just optimism and quarterly reports based on assumptions. It's not just a flaw, it's structural opacity, and it's getting worse. In fact, many asset managers now depend on private marks to smooth volatility, inflate performance, and secure fundraising. Volatility in public markets hurt them, but private marks, they're stable until they're not. And when one big player is forced to revalue downward, the pressure starts cascading. Funds compare valuations to peers. If one firm adjusts, others must follow, or risk lawsuits, redemptions, collapse. So the question isn't if this illusion cracks again, it's when, and who will trigger the fall. Because next, we're going to see how this invisible tension is already showing signs of stress, and why the first major correction might not come from a bank or hedge fund, but from your retirement fund. And when that moment comes, no model in the world will be able to stop it. For years, the illusion held. Private valuations kept climbing. Funds reported steady gains quarter after quarter. And investors, from billion-dollar pensions to everyday 401ks, believed the numbers. But behind the curtain, something started to shift. In early 2023, a quiet panic began inside some of the biggest institutions. Redemptions were rising. Private investments that once looked untouchable weren't selling. Buyers vanished, prices softened, but the marks, they stayed the same. Then came the first cracks. A massive U.S. pension fund wrote down several private equity stakes by over 20%. No warning, no external shock, just revised assumptions. Suddenly, everyone else had to choose, adjust their own marks, or admit they'd been overstating value for years. Some chose silence. Others quietly revalued assets downward. But none of them called it what it really was, a reckoning. The trigger wasn't a collapse, it was a math problem. Liquidity dried up, assumptions no longer made sense, and with a system built on narrative,
Changing the story meant changing the balance sheet. And balance sheets don't lie for long. One real estate megafund, once valued at $60 billion, saw redemption requests skyrocket. They blocked withdrawals, blamed market conditions. Internally, they knew the truth. If they sold at real market prices, the illusion would collapse. Another fund tried to delay markdowns by quoting strategic value. That phrase, a red flag in financial circles, means we can't justify the price, but we're not ready to admit it. And here's the most dangerous part. This slow-motion unraveling isn't just happening at the top. It's creeping into pension funds, university endowments, insurance portfolios, institutions that depend on stable, predictable returns, institutions that affect millions of people. They trusted the numbers. They built forecasts, obligations, and payouts based on them. But if those numbers were air, what happens when reality catches up? Let's be clear, this isn't 2008. There's no sudden crash, no domino effect yet. But the illusion is cracking in silence. Assets aren't selling, marks aren't moving, and behind the scenes, auditors are getting nervous. There's talk of valuation reviews, of model recalibrations, of temporary portfolio adjustments. Different words, same truth. The fantasy is breaking, and as that happens, the financial world is entering uncharted territory. Because this time, the problem isn't hidden in toxic mortgage bonds. It's embedded in the system's core. It's legal, standardized, and widely accepted. And the question no one can answer is this: how do you unwind trillions in imaginary gains without triggering a very real collapse? The system was never designed for this because it was never supposed to be tested. But it will be. And when it is, the first people to feel it won't be hedge fund billionaires. It'll be the people reading their quarterly statements, realizing the growth they trusted never existed. They told you the numbers don't lie. But numbers don't speak for themselves. People give them meaning. And sometimes, illusion. For over 2 decades, we've built a market that rewards confidence over caution, projection over proof, story over substance. And now, beneath the surface of bullish headlines and booming portfolios sits a question no one dares to ask out loud. What if the value we trusted was never there? Because when perception becomes profit, truth becomes optional. And eventually, optional truths become unavoidable consequences. If you believe more people need to see this to understand the system behind the screen, hit like, subscribe to Bull Secrets, and share this video with someone who still trusts the surface. Because next time you read record earnings, ask yourself, based on what?